continuing with Chapter 1, we're now moving to our third module or learning objective. And here we want to describe the accounting equation and define assets, liabilities, and equity. Assets, liabilities, and equity are the components of the accounting equation. The accounting equation is sometimes called the balance sheet equation, and the accounting equation will be the first device that we will be using to record business transactions. And very simply, the accounting equation tells us that assets have to be equal to liabilities plus equity or capital. The accounting equation must always be in balance. Now, I think early on, when we talked about our understanding of the nature of accounting, we talked about the economic resources, we talked about the obligations, and the wealth. And this is what we're seeing here. Because the accounting equation is the essential foundation of accounting. And again, it must always be in equilibrium. In other words, assets always have to equal liabilities and stockholders' equity. We're going to define each element of the accounting equation. And I think for now, before we get into the understanding, we need to be sure that you look at the equation very simply, and it's not anything different than any other equation you may have seen in basic mathematics. And that is when something changes in the equation, an equal and opposite change must take place somewhere else in order to keep the equation in balance. When we look at some of the details, again, we look at assets as the economic resources that the firm owns, and liabilities and equity are claims against those resources. Very simply, we have two types of claims. We have creditor claims, and that's the bank, or any other creditor that extends credit or lends money to the organization. And the owner's claim is the residual claim. That is, what is left over. So if we think carefully about the residual claim and the idea of the creditor's claim, let's say you have an auto purchase. And when you purchase that auto, you have a down payment of $5,000. Now, that's as much as you could afford. You shop and you find an auto that will cost you $25,000. Therefore, you have to borrow the other $20,000. If you were preparing an accounting equation for yourself, after you buy the auto, you will have assets or economic resources of $25,000. But the question is, and again, these are economic resources that are owned or controlled by the entity. And what are the claims against those resources? Well, right now, until you pay off that liability, the bank or the auto dealer who extended you the credit has a claim of $20,000, and that's a senior claim. You have equity of $5,000. That's all you invested in this asset so far, and that's a residual claim. And again, the asset is your economic resource, and these are the claims against the resources. And once again, the residual claim or the equity is going to be your claim or your owner's claim. This is the creditor's claim, the liability. And again, the balance sheet has to balance. The economic resource of $25,000 is going to be equal to the total claims against economic resources of $25,000. Okay. So this is the way the balance sheet operates. Again, economic resources have to be equal to claims against those resources. And the senior claims, of course, are the banks or the auto dealer that would provide that credit. And of course, that has to be paid first. That's why it's a senior claim. You have a residual claim, whatever is left over. So if for example, going back to our automobile illustration, if the auto was only worth $20,000 at the end of a year and you couldn't pay for the car, well, you could sell the car to try, or you couldn't pay for the bank loan. You sell the car, you sell it for 20, you have to pay off the bank first. They have the senior claim. Your claim is going to be unsatisfied because you're not going to be able to collect more than $20,000. So that's why we say the senior claim is coming from the creditor side. Okay, those are the senior claims against the assets. So by definition, what are the elements of the accounting equation and how are they defined? Assets, of course, are the economic resources that have future expected benefit to the organization that are either owned or controlled by the entity. And it's important when you look here at the term controlled. What assets do you have that you may be controlling but you do not own? And right now it's very common that you could have a leased asset. So you can lease a car or buy a car. If you buy the car, you own it. If you lease the car, you control it. You don't have title. Other assets include inventory, cash. Inventory, of course, are the goods that you hold for resale. Land, of course, could be used for future development, maybe a parking lot. And then furniture and fixtures, and then other equipment within the organization. Assets could be tangible. Cash, land, buildings, inventory, these are tangible assets. You could also have other assets that are claims to cash. So assets could be claims to cash. They could be accounts receivable. In other words, someone owes you money, so you sell a product on credit. So you would have a debt owed to you. A note receivable, the only difference between an account and a note receivable is that an account is an open account, just like using a credit card. You go online, you give your credit card number, nothing is signed, but a note receivable is more formal. This is a formal written promise to pay, and it usually carries interest. Accounts receivable, sometimes called open or trade credit. Other assets that are not tangible in nature would be investments in other companies. So you buy the stock of other companies. So one type of asset is tangible. Second type would be claims to cash that you have. So for example, again, you sell a product on credit. Someone owes you that money. You have to set up a receivable. On the other side, I should say on a more formal side, you could have a note receivable. And by the way, this is the opposite of the bank loan. What if you were the bank and you lent money to the person buying the car? The notes receivable would be on your asset. So that's the second type. So you have tangible, you have claims to cash, and we have a third type, which are intangible assets. Intangible assets, oops, sorry about that. Intangible assets, go back, will be assets that lack physical substance but are owned by the company. So an example of a tangible asset, an intangible asset rather, so a third type, and again these are rights. So intangible assets are assets that lack physical substance but have value. And this is where the asset value comes in. They have value because the rights that they confer on the owner. And these intangible assets would include your patents, copyrights, trademarks, and we mentioned this, I guess, in one of the other modules, that things like goodwill that you would only record if you buy them, or the Nike trademark, we mentioned you would only record it if it was purchased. So these intangible assets have value to the holder. Another example of a right that you have as an intangible is a franchise. So you buy a franchise to sell McDonald's. So you pay money to obtain a piece of paper that gives you the right to sell the McDonald's product. So although it is not tangible, there is a document that gives you the right to sell this product, and that right has value. So these are another type of asset, an intangible asset. So the three types of assets we have are tangible, we have rights or claims to cash, and then we have these intangible assets. The next element of the accounting equation are liabilities. And liabilities, as we suggested, are debts that are owed to outsiders or creditors, and they include notes payable, and those are formal documents, formal written promises to pay, as we said. These are senior claims to cash. So these are formal written promises to pay. Usually there is an interest component, just like an auto loan or a college loan. Accounts payable, that's the other side. That's when you buy inventory from someone, or you're the person that's using a credit card online to charge a product, and they in fact will not ask you to sign anything, but this is still going to be a liability, and it is, as I said, for a business, it's open or trade credit. So if you had a business and you needed to order supplies, you could just call up your supplier. Maybe it's a company like Staples or Office Depot. They will send that to you, and then you pay the bill. There's no formal document that has to be signed, and interest does not start unless you don't pay within the period of time. Typically, the open trade credit is for a period of 30 days, and the notes payable is usually longer than 30 days. And of course, you could have other liabilities for salaries and wages. So again, as we said, we think of liabilities as creditor claims against the assets of the firm. It's a senior claim. And again, notes payable, loans payable, utilities, accounts, taxes, and salaries would include or would be included in the liabilities. Now, these are, as we say, obvious debt, things that you would think of as liabilities, but they could be something else that you may not think of as a liability, and that is an advance collection. You also have liabilities when you collect revenue in advance, and it may sound strange to call these revenues because you haven't earned anything yet. These are unearned revenues, sometimes called deferred credits. It's a liability that is created whenever you collect cash in advance of providing the service or delivering the goods, sometimes called advance collections. So these are very, very common. Here we pay off the liability not by paying cash, we pay off the liability by providing the service or by delivering the product. So that an example would be if you collect subscriptions. Insurance premiums. Season tickets. When the cash comes in, you have cash, but you have an obligation. You have a liability to deliver the magazine or to allow online access for a period of time. You collect the cash, but you have a liability to provide insurance coverage for a specified period of time. And you have a liability if you collect season tickets in advance, let's say for the Giants or the Jets or any other sports franchise, someone pays those season tickets in advance, you have to deliver the tickets and also deliver the entertainment at the same time. Other liabilities include warranties. Warranties come with the product, and we have to come up with an estimate. Obviously, we're not sure as accountants how much it's going to cost us to fix or repair damaged products. So when we sell products, we have to estimate how much we believe is going to be the cost of fixing or taking back a damaged product. So we have a warranty liability. And finally, other liabilities that we may or may not record are sometimes called contingent liabilities. These are potential liabilities that could occur if an event in the future occurs or fails to occur. A very, very common example of a contingency is a lawsuit. Do you have to put a lawsuit on your accounting equation or on your balance sheet equation as a liability? And that will depend, as we'll see, on the probability or the likelihood that you will lose that lawsuit. So contingent liabilities are not always recorded. In fact, you could probably think of the warranty liability as a type of contingency. You'll only have to pay to fix the product if the product proves to be defective. The last element in our accounting equation is capital or equity. This is the owner's claim against the assets of the firm. And again, it is considered to be a residual claim. Residual because you can only take part of these assets back after all your liabilities have been paid. So this is a residual claim against the assets of the firm. You are not permitted to take assets out of the company before you pay off your debt. And there are three components of equity, or the three main components of equity. The first is called contributed or paid-in capital. This is sometimes called paid-in capital. And contributed or paid-in capital consists of amounts that have been invested in the company. So, for example, go back to the automobile illustration. In the event that you were buying that car for a business, you would have the cash that you invested as your capital that you contributed in that company. Now, of course, for us, we're going to be looking at corporations. So here we're going to be looking at capital stock. You sell shares of stock. When you sell them in the market on the New York Stock Exchange, for example, so we know that Apple shares are traded on the New York Stock Exchange. If you need to raise capital in a public marketplace, you could also be privately held where the individual investors put in their own money. But when you go public, I guess you know that Facebook went public, and I guess Twitter has now gone into the capital markets by issuing capital stock. So that's your paid-in capital. What are your retained earnings? That's your second component. Retained earnings represent the historical record that has not been paid out of the company. So that we'll go into more details in a moment, but the retained earnings account represents all of the earnings of your company that have not been paid out as dividends. So essentially, this is net income minus dividends every year. That's going to be your retained earnings. Comprehensive income, a little bit more complicated, and we'll explain that later, but that's your third component. And that would be other elements of income. So in the accounting equation, the element known as capital or equity, again, has those three main components. So once again, to summarize, it's contributed or paid-in capital. As I said, we'll discuss accumulated other comprehensive income a bit later. And then we have retained earnings. Contributed capital, as I said, includes the amount of common stock sold, common or preferred stock, but we'll talk about common stock. When stock is referred to in general, it is known as capital stock. So in general, sometimes it's just referred to as capital stock. And this is the cash that you receive when you go to a public market, or even privately, if you sell somebody a share of stock in your company and you're not traded on a stock exchange, the cash you receive, usually the stock has a par value, and amounts over par value are called additional paid-in capital or paid-in capital in excess of par value. So that if you think about, I'll go back for a minute. If we think about selling stock and when we sell stock, we should really say issue. Say it's on the New York Stock Exchange. Let's say that you're selling 100 shares of stock. And each share of stock, as we'll see, each certificate has a par or a face value. Now let's say that par value is $2 per share. When you go to the marketplace, let's say there's demand for that stock and someone's willing to pay $50. If you sell the stock for $50 per share, that means that for every share of stock that you sell, okay, so for every share of stock that you sell, you're going to have $1 is par and $49 is additional paid-in capital. Or paid-in capital in excess of par value. So even though you receive the full $50, contributed capital is made up of two components. It is made up of the par value of the stock as well as the excess over par. I'm sorry, $2 here. Let me go back. So let's say the par value again is 2. That was my original assumption. And the additional paid in capital in this case is 48. Okay, so par value is $2, and if you sell it for 50, the additional paid in capital is going to be $48 per share. The total amount of $50 is contributed capital, so the total amount per share is contributed capital. So contributed capital is 50 with a par of 2, and paid in capital over par or additional paid in capital is going to be for $48 per share. When we look at accumulated other comprehensive income, this gets a bit complicated, but the key term here is other comprehensive income. So that's the critical piece of it. It's the other comprehensive income that is important. Other comprehensive income includes gains and losses from investment securities that you're not selling. They're unrealized. So that what we have here is very simple. If you think of it as you hold, let's say, 5 shares of Google stock right now. Google stock goes up in value. Your wealth has gone up so that comprehensive income will go up, and we accumulate that in your capital or your equity on the balance sheet or on the balance sheet equation. So that if Google stock goes up, your wealth goes up. But since you didn't sell the stock, or because you didn't sell the stock, that is considered unrealized. And these are sometimes known as paper gains and losses. So you might hear the term, I have a paper gain, or on paper, I've earned more because the stock went up. So these are not reported on the income statement because there is a low probability that you're going to realize the cash in the short run. You're going to hold the Google stock. Let's say it's in your pension plan. You're not going to sell it. So other comprehensive income represents unrealized gains and losses that you don't expect to sell or realize in cash in the short run, in a short period of time. These were normally thought of as the transitory components of income. So we typically looked at these as transitory, so the gains and losses would offset over time. So if you held Google stock long enough, over time, you'd have, let's say this is your purchase price. It would go up, go down, and, average out. At some point, your gains and losses would average out. So therefore, it is considered transitory. Gains in one period would be matched with losses in other periods if you're not going to sell them. And that's the point. If you don't expect to sell them in the short run, then there is a very low probability that cash will be realized. Now, the change in other comprehensive income is typically reported in a statement that we'll look at, which is a separate statement that outlines the changes in shareholders' equity. Now, the equity account, again, as we said, is going to be a owner's claims against the net assets of the company. And your claims will increase by investments, by contributing capital, and the other way your wealth increases is by your earnings minus the dividends. So your net income is here. That's your net income. It's your, or loss, it's revenues minus expenses. And dividends will be paid out of retained earnings. So the change in retained earnings is net income or net loss minus any dividends. So the change in retained earnings is net income or loss minus any dividends. So let's go back to the whiteboard. And when we look at the change in retained earnings, that's going to be equal to your net income, your profit, or net loss minus any dividends. Dividends are withdrawals of profit, of income from the company. Distribution. Sometimes you might want to look at it as a distribution of profit. So this is the change in retained earnings. Now, the net income or the net loss for the period will be your revenues. For example, sales minus any expenses. So that is your net income or your net loss for the period. And again, it is going to be reflective of the results of your operating activities. So owner's equity will change. The claim against these resources will change as the company engages in economic activities. And again, from operations. So by definition, probably to me, the best way for you to look at retained earnings is the historical record of earnings and losses that have not been distributed to the owners as dividends. And again, retained earnings consist of three items. These are the changes, revenues, expenses, and dividends. Revenues increase retained earnings, expenses reduce retained earnings, and your dividends will also reduce retained earnings. As a company earns revenues, assets increase, and therefore your claims against those assets increase as well. When you have expenses, your assets go down, and your claim against those assets will also decrease. Income or loss results from transactions with external parties. So you have to remember, we can't generate revenue or expenses internally. It's like paying ourselves a salary or doing our own work. So that net income or loss is a result of transactions with external parties. And these are business transactions with external parties. And these external parties would include, for example, customers, suppliers, and even employees. And you might say that employees work for the company. Why are they external? they are not owners of the company. So revenues, expenses, net income or net loss will be a result of business transactions with external parties. Now, of course, when we look at other events that could change the stockholders' equity section, we know that other events that change assets of the companies would be investments. We mentioned this, that when you invest capital stock in the company, these are investments, and other transactions that change stockholders' equity are distributions. But please notice the difference. Issuing capital stock and dividends are not transactions with external parties. These are internal transactions with their owners, so that you cannot get revenue from investing. You do not have an expense when you have a dividend. So this is key. Dividends are not expenses. What you see here is known as, or could be called, a capital transaction. When shareholders invest in the company or when there are dividends paid, these are not expenses. These are not revenues. So if we go back to the whiteboard and now we set this up and trying to take a little bit of a breather and just go back and look at equity. Let's look at how equity could change. Equity could change by investments, equity will change by dividends, and equity will change by net income or net loss. The difference here is that capital investments by owners, you're putting your own money in, so it's not income. Dividends paid to owners is taking your own money out of the company, and it's not paid to outsiders. So when we look at revenues, minus expenses, that's going to be equal to a net income or a net loss for the year. Capital investments are not revenues. Dividends are not expenses. Revenues and expenses are external transactions. Investments and dividends are capital transactions. Okay, so when you invest money, it cannot be revenue. When you have a dividend, it is not an expense. These are known as capital transactions. Now, when we think about the net income and the external transactions, the first one will be revenues. And what are revenues? Revenues are increases in economic resources that are earned by performing some economic activity, that is, delivering products or providing services to customers. Now, the first thing we need to do is distinguish some terminology. Although the effects are exactly the same on the accounting equation, the effects are exactly the same on net income. What are revenues and what are gains? Revenues are gross increases from, or in stockholders' equity, from your normal business activities that you enter into for the purpose of earning profit. Normal business operations. So they're asset inflows, or they reduce liabilities resulting from the normal operations of the business. And you might say, well, I understand that when I sell a product, I get cash, So I know that revenues would be asset inflows, but the question I guess you have in your mind is how can a revenue be a reduction of a liability? Well, don't forget, if you collected, let's say, an insurance premium in advance, or let's say you collected a subscription, collected in advance, that's a liability. That's a liability. So that when you deliver the product, revenue goes up and the liability goes down. So when the product is delivered, when the magazine is delivered, revenues are going to go up and the liability will be decreased. So on delivery, and that delivery could be online, that delivery could be in the mail, revenue goes up and the liability goes down. Okay. So on delivery of the magazine or giving access to the individual that paid the subscription to have that magazine or that periodical online, that is delivery. When delivery is made, revenue goes up, liability is decreased. Gains, although they increase your wealth, are not from normal operations. They are asset inflows or reduction of liabilities from peripheral or non-operating activities. So here's a perfect example of a revenue versus a gain. Dell sells a computer, it's revenue. But if Dell sells a building at an amount greater than they paid for that piece of property, it is a gain. Take it the opposite way. Take a real estate company that sells a building, that's revenue. If they sell a computer, an old computer, that's a gain, or if they sell it for more than its cost, it would be a gain. The next element of revenue and expense, or I should say the next element of net income, is expenses. And that element tells you that expenses are the cost that are associated with selling your product or providing services to those outside the entity. So answering what are expenses, these are the cost or the disbursement of assets in order to provide goods and services. Now, once again, these costs will look very much the same, but sometimes we call them expenses and sometimes we call them losses. Losses are the cost of goods and services consumed in the process of earning revenue from, again, from normal operations. So again, we're talking about earning revenue, and this is from normal operations. Asset outflows or increases in liabilities, that results again from normal operations, whereas losses are a result of asset outflows or increasing liabilities from peripheral or non-operating activities. So if we want to compare the two, going back to the Dell example, if Dell pays an employee's salary, it is an expense, but if it sells a building for less than its cost, it is a loss. An employee's salary is part of normal operations, and that's why it's an expense. Okay, so if it's part of normal operations, it is going to be considered an expense. Here, when it sells a building for less than it costs, it's a loss, and this is not part of operations. Dell is not in business to sell real estate. They are in business to manufacture and distribute computers and other technology, and they need to pay their salaries for that purpose. Now again, we talked about the other changes in equity aside from net income or loss, which consists of revenues, gains, expenses, and losses. There are also going to be dividends. And again, dividends are distributions or withdrawal of cash or other assets to their owners. They reduce retained earnings. A critical point, again, these are not, absolutely not expenses. They are not expenses, they're not deducted when we determine net income, but they are in fact considered distributions of net income. The amount of the annual withdrawal of dividends is usually limited by the company's profit or the cash needs of the company, and therefore they want to be sure that the company is able to have sufficient income or cash so that it can continue to grow and make investments back into the company. So to summarize the accounting equation, we know that assets equal liabilities plus equity. Assets are relatively straightforward. Liabilities seem very clear, but the equity section is a bit complicated. So what we need to do is think about, and again, we're not going to really worry about the other comprehensive income right now. So the two components that we focus on for the most of the course is going to be contributed or paid in capital and retained earnings. Contributed or paid in capital, again, these are the amounts that are paid in by owners or investors, and with common stock, usually common or capital stock. This is going to be, as we showed you the example, at par value plus paid in capital in excess of par sometimes called additional paid in capital. Retained earnings, changes by revenues and gains, expenses and losses. Together, this would be your net income or net loss. And also minus any dividends. And again, dividends are not expenses. When we look at reported income or loss for the period, if revenues and gains exceed our expenses and losses, we have a net income. If revenues and gains are less than expenses, we have a net loss. So again, on the accounting equation, once again, the two components that we're going to be focusing on contributed or paid in capital, capital or common stock. I want to use the generic term capital stock here. At par, let me just get that corrected. At par value plus additional paid in capital. Okay. The other element that we're going to look at is the retained earnings. And as we said, retained earnings is going to be equal to net income or loss minus dividends. Revenues plus gains minus any losses and expenses would give you a net income or net loss. Or loss for the period. Then, retained earnings also changes by dividends. Dividends, as we said, will be a distribution of income, not part of the determination of net income. So that ends this module, and we're going to pick up on developing more in terms of using the accounting equation for purposes of recording transactions as we move through the next part of the chapter.